we're going to talk about how to invest in a rising rate environment. We have Bill Addiss joining us today, who is a market analyst, spent many years in the bond markets and in financial institutions around the world. He's also an online trading academy instructor, so welcome back.
Great to be back. Thank you, Marlon.
Happy to have you with us because we talked in our previous sessions about the forecast and anticipating there might be several rate hikes this year. Let's talk one step deeper about how we might want to invest or protect ourselves in that type of environment.
Good. And I think it's a critical question because literally this is the first time in over a decade where we now have interest rates on the rise.
Yeah.
You know, a lot of us just remember the slow, ever declining, low, abysmally low rates. Now we're getting into a rising interest rate environment, which is going to be the first time this has happened in over a decade, and does require you to rethink your portfolio and make fundamental changes to your portfolio.
It's been easy when you have very low rates. You just pretty much buy the equity markets and it's going to keep going up and up and up. Which is, I would tell you that from 2009 through till today, I have heard of so many genius stories. And this market's so great, making a ton of money. Well, everything works until it doesn't. So what are some of the simple steps that we can look to maybe hedge or protect ourselves should we start to see some fallout from this?
Great question. And the first point that I want to stress is to look at floating rate products.
Okay.
And what I mean by that is the vast majority of bonds and CDs here in the United States are what we call fixed rate, a fixed coupon. We even call the bond market the fixed income market. But there is a variety of product out there that the coupon of the bond will adjust or reset on a periodic basis.
Okay.
So it's a floating rate coupon. And what I would propose to you in a rising interest rate environment, floating rate bonds are what you want to own.
Okay.
Because think about it, if inflation starts going higher, if interest rates start going higher, your bond will actually benefit from this by ever increasing income. Versus a normal portfolio, if you had fixed rate bonds and interest rates went up, the price of those bonds would go down. You'd be getting hurt. So you're turning a disadvantage into an advantage.
Got it. Now, is there a premium that you pay for these?
Well, it depends what the benchmark is that the bond is floating to. And what I mean by that is when you have a floating rate bond, the coupon is going to reset every 3 or 6 months.
Okay.
But the question you have to ask is what is it resetting to?
Right.
You might have heard of something called the LIBOR rate. Or the T-bill rate, or an index of some sort.
Right.
So it's hard to answer that question without knowing what it is, but every floating rate bond does affix its coupon in relationship to some other interest rate.
And I think this is where, when you start to jump into that arena, that you look and see what it is anchored to, because I've known friends that have had their mortgages attached to the LIBOR, which has been great for them.
Right.
You have others who are not on an market index, which their rates have been rising. So very important to look at the basis for some of these instruments. So what sort of instruments are we looking for? I mean, floating rate, I know it might be a foreign topic to a lot of viewers out there.
And to most U.S. investors, it's a foreign topic because, as I said, only about 7% of the market is float. But when we look at the variety of floating rate products, there are corporations that issue floating rate bonds. There are municipalities for tax-free income that issue floating rate bonds. But the single largest category under the umbrella of floating rate bonds is a product that the U.S. government offers called a T.I.P. And T.I.P. is a floating rate bond, and it's actually an acronym, T.I.P.S, Treasury Inflation Protection Security. The government loves acronyms. Now, in this case, the bond, the coupon of the bond changes in relationship to inflation, called the CPI index. Many of you have heard about. Exactly, the monthly adjustments. So however much the CPI goes up or down, that's how much the coupon of this bond goes up or down. So if you're expecting inflation to be a problem, and that would be measured by CPI, it would make sense that you would want to buy a bond that would actually benefit from that rising CPI number.
Wow.
So these TIPS bonds, I think for the average investor, do make an awful lot of sense if you believe interest rates are going up, which we have discussed, we firmly do.
It's funny because it's not a mainstream thing. You don't hear a lot about TIPS, and I get a lot of questions about, I'm going to buy TLT, or I'm going to buy some bond ETF like SHY to protect my portfolio. And it's like, well, first off, those bond ETFs are all constructed differently. Some are, market-based, some are going to be treasury-based, but those can have an element of risk to them because they're fixed. They're usually stuck at a certain maturity. Interesting to hear that the floating rates would adjust with current markets, and I think there's a lot of people that are expecting there to be a significant rise in interest.
Absolutely, and I would strongly stress, if you had a traditional portfolio of bonds, that rising interest rate would be hurting you.
Right, you can get crushed.
Now we're going to turn that around and turn it into a positive.
You're like,
rising interest
rise away.
Rise away, exactly. So I really do think these warrant attention, although I will agree they're a bit more sophisticated than the traditional bond, require a little bit more homework.
All right, so step number one in capitalizing on kind of a rising rate environment is going to be using floating rates. TIPS is one example. What else can our viewers do?
The other thing you want to do is you want to shorten the maturity of your portfolio.
Okay.
Now, if you think about it, normally, if you buy in longer term investments, your rate of return should be higher. That hasn't always been the case recently, where interest rates have been very flat. So in today's world, with rising interest rates, what I would suggest the investor should do is, if you have certificates of deposit or you have bonds, is to start buying shorter maturity bonds. And that will give you the benefit of having what's called reinvestment risk. Because when a bond matures, you get your $1,000 back at maturity. So if you create this stream of ever maturing bonds, that means you're always going to be getting your money back at 100 cents on the dollar, and you'll be able to take those proceeds and reinvest them back in at the new and higher interest rate.
And that's going to work really well in a flat yield curve environment, because why would I want to lock my money up for a 30-year when I could buy something very short and keep rotating that and have that safety?
Exactly, and I'm wholeheartedly agreeing with that observation. I'm saying you shouldn't, but don't just buy one maturity, buy a sequence of maturities to give you that kind of evergreen income coming in to be able to reinvest at the new and higher rate.
And if you want to know more about yield curves, there are some videos at otacademy.com where we talk about the yield curves. And based off that strategy, buying the shorter term, we might see an environment here in the near future where we actually have an inverted yield curve, where all of a sudden the shorter term maturities would actually be paying more than the longer term. So something to keep an eye on. It's not normal to have an inverted or a flat market, but those are, as we talk about in other videos, kind of cautionary notes and can lead to market recessions. Normally, you have the short term is going to be paying much less yield than the longer term because you are committing your money for an extended period of time. All right, so we're talking about shortening the maturities that we're looking to get. We're also talking about the tips. What else we got?
Good. And then the other thing from a pure strategy trading point of view is to looking to go short the market. In other words, if we're talking about bond yields going higher, that means prices are going down. You want to short the market. And that leads us to a variety of different asset categories, whether you're looking at bond futures contracts, bond note futures contracts, so we can trade this on the futures side. But there's also a whole family of ETFs that offer inverse ETFs, where a deterioration in the price because of higher rates actually results in a rising price to the ETF. So if you look at the whole universe of inverse ETFs in the world of bonds, they get even more sophisticated. You could have some that are leveraged, meaning for every 1% move, you get a 2% move to the security.
Could be risky.
When you use leverage, you can use the word risk interchangeably. So you could have some that are leveraged 3 times as much in the Ultra Pro series, or you could just have the dollar for dollar. But the inverse ETFs can be a very interesting way to trade this price deterioration.
And for those of you who might not know what shorting is, I know it's a foreign topic to a lot of investors out there. Most investors are used to the term going long, which is just buying something at a lower price and you're expecting to sell it when it moves higher. So you bought it at 10, you're going to sell it at 20, and you make your profit of 10. Shorting is the opposite. It's making money when things decline. So you sell it at 20 and you buy it back at 10. Now, from the discussions that Bill and I have been having on bonds and the yield curve and kind of interest rates going forward, remember that when the interest rates start to rise, the prices of those bonds will be dropping. So you don't want to buy a bond ETF because the value of that bond ETF is going to decline. Therefore, you could be buying inverse ETFs, and you can find a bunch of those online. Please be careful out there. Bill mentioned there are leveraged ones, which means you could get a double or triple the moves in your favor or against you. So I certainly want to be very, very careful when looking at some of these inverse ETFs out there, but they are options to capitalize on that falling market out there. All right, so we've looked at some of the inverse ETFs. That's a great alternative out there. Again, be careful with the leverage. Let's give us one more for our viewers out there.
I would say a lot of the liquidity in today's world is found in the world of the futures contracts. And we've got a variety of actual contracts along the yield curve. There's a 2-year Treasury note, 5-year, 10-year, 30-year. And I would say the 5-year, 10-year, and 30-year seem to be where most of the liquidity is. So if you're looking for a rising interest rate environment, that bodes you want to go short those contracts for delivery out at some point by which this would have happened. So you're certainly not looking at the near-term March contract. And just shorting the Treasury note or bond contract. And you've got a lot more volatility there. The concept of duration we've talked about. The 30-year bond contract has 2.5 times the volatility of the 10-year note. So be careful to look at the duration when you're looking at those.
Well, one thing I'm going to say no for certain. I hate using that word certain. One thing we can be pretty sure of is we will see rates increase. We are at historical lows. We talked about that in past sessions. When we have that type of environment, rates can pretty much go in one direction only. We talked about the major buyers of bonds disappearing out there. So that is going to give us an environment where prices of those will be dropping and interest rates will be rising. So How do we capitalize on that? Well, we talked about having floating rate products like T.I.P.S. We've also looked at shortening the maturity of our bond portfolio. If you have a bond ladder or you're looking at a bond barbell, we can start to adjust those components to tailor fit that kind of rising rate environment. We also talked about looking at inverse ETFs. So we have exchange traded funds, which a lot of investors like to buy. Think of the inverse there. So when the bond market starts to sell off, these ETFs will actually start to do well and go up in value. And there's also leverage ETFs. And finally, the futures markets. There are a lot of futures products that are traded on the interest rate products out there, like the 5, the 10, the 20, the 30. So a lot of these products can be traded in that manner, and those different instruments, those different assets could give us a place to park our capital and also to capitalize on a rising rate environment that we are pretty sure we're going to see going forward. If you'd like to learn more, go to otacademy.com to find out more information about bond markets and how to protect your portfolio.